Investing is an exciting journey to financial freedom, and with the right strategy, you can maximize your returns and achieve your investment goals. Whether you're a seasoned pro or just starting out, this video is for you. Ready to learn about the 6 biggest trader mistakes and how to avoid them on an exciting adventure? With our expert insights and proven strategies, you'll be equipped with the knowledge and confidence to make informed decisions and reach new heights as a successful investor. Don't let common pitfalls hold you back from reaching your financial goals. Embrace the thrill of investing and join us in discovering how to navigate the investment world like a pro. Number 1. Not having a clear investment strategy. Investing can be a complex and confusing process, and without a clear investment strategy in place, it can be difficult to achieve your financial goals. A well-defined investment strategy should take into account your personal financial situation, your investment goals, and your risk tolerance. It should also consider the investment vehicles that will help you meet your goals and should be reviewed and adjusted on a regular basis as your life circumstances and financial goals change. Not having a clear investment strategy can result in impulsive decisions, an inability to stick to a plan, and ultimately missing out on potential investment opportunities. It is also important to remember that investing is not a one-time decision. Your investment strategy should be a long-term plan that evolves over time to reflect changes in your life and the markets. Consulting a financial advisor can be a valuable resource in developing a clear investment strategy, as they can help you to assess your financial situation and determine the best investment vehicles to meet your goals. Number 2. Failing to diversify investments. Diversification is a critical component of a successful investment strategy. By spreading your investments across a variety of asset classes, industries, and geographic regions, you can reduce your overall risk and increase your chances of achieving your investment goals. However, many investors focus too heavily on a single investment or a single sector, putting all their eggs in one basket. This leaves them vulnerable to market volatility and the potential for significant losses. For example, if an investor has all their money in technology stocks and the technology sector experiences a downturn, the investor's portfolio will likely suffer significant losses. On the other hand, a diversified portfolio can help to minimize the impact of any one investment's performance on the overall portfolio. By spreading investments across a variety of asset classes, industries, and geographic regions, investors can reduce their overall risk and increase their chances of achieving their investment goals. Additionally, diversification can help to ensure that your portfolio is not overly reliant on a single market or economy. This can be particularly important during times of economic uncertainty or market turbulence, when a diversified portfolio can help to reduce the impact of market volatility on your investments. Number 3. Timing the market. Timing the market refers to trying to buy or sell investments based on predictions about future market performance. While it may be tempting to try to time the market, it can be a difficult and potentially costly strategy. The stock market is highly unpredictable, and even the most experienced investors can struggle to accurately predict short-term market movements. As a result, attempting to time the market can lead to missed opportunities and potential losses. It is also important to remember that timing the market requires a significant amount of time and resources, and even with the best research and analysis, the results can still be uncertain. Furthermore, the act of trying to time the market can cause investors to miss out on the benefits of long-term investing, such as compounding and the power of reinvested dividends. A better approach for long-term investors is to focus on building a diversified portfolio and investing for the long term. By investing regularly, regardless of market conditions, you can help to ensure that your portfolio reflects the overall performance of the market, rather than trying to predict short-term market movements. Number 4. Chasing high returns. Chasing high returns can be tempting, but it's important to be cautious of investments that promise exceptionally high returns. These investments may be high risk, and they can result in significant financial losses. Instead of focusing solely on returns, it's important to consider the overall quality and stability of the investment, including its management, financials, and risk profile. By doing so, you can increase your chances of investing in high-quality assets that are more likely to deliver stable and consistent returns over the long term. Number 5. Ignoring risks of investing. Investing always involves some degree of risk. While taking on more risk can potentially lead to higher returns, it's important to be aware of the risks involved and to carefully consider your risk tolerance before investing. Ignoring the risks of investing can result in impulsive investment decisions, and you may end up exposing yourself to more risk than you can handle. To help minimize risk, it's important to diversify your investments, invest in a range of asset classes, and regularly review and adjust your portfolio to ensure that it continues to meet your financial goals. Number 6. Over-relying on emotions. Emotions can play a significant role in investing, but it's important to avoid letting emotions drive investment decisions. Over-relying on emotions can lead to impulsive investment decisions and can result in significant financial losses. To help minimize the impact of emotions on investment decisions, it's important to develop a clear investment strategy, diversify your investments, and regularly review and adjust your portfolio. Additionally, it may be helpful to work with a financial advisor who can provide impartial investment advice and help you stay focused on your long-term investment goals. Investing can be an exciting journey to financial freedom, but it's important to avoid the common pitfalls that can trip you up. The 6 biggest mistakes to watch out for are lacking a clear investment strategy, failing to diversify your portfolio, trying to time the market, chasing high returns without considering the risks, ignoring the warning signs, and letting emotions drive your decisions. Don't let these mistakes hold you back from reaching your financial goals. Instead, arm yourself with a rock-solid investment strategy that takes into account your unique situation and risk tolerance. Diversification is key to a successful portfolio, so spread your investments across different asset classes and industries. Timing the market is a losing game, so focus on consistent and informed investment decisions instead. Don't be lured in by the promise of high returns without considering the risks, and stay mindful of warning signs. Finally, don't let emotions cloud your judgment. By avoiding these common mistakes and following these recommendations, you'll be well on your way to becoming a successful investor and securing your financial future.